What if I told you that the greatest investor alive didn't build his fortune on complicated formulas or risky predictions, but on one rule so simple most people ignore it? A rule so obvious that when you hear it, it almost sounds disappointing. But behind that simplicity lies a mystery. Why do the world's smartest people break this rule every day, while Warren Buffett follows it so strictly that he refuses to touch entire industries? Today we're uncovering why by what you understand isn't just advice. It's the foundation of every financial empire. And it might explain why most investors lose money even in a booming market. Stay with me, because this simple rule hides a much bigger truth. Understanding isn't optional, it's survival. To understand where this rule came from, we go back to Omaha in the 1930s, a time of bankrupt banks, collapsing companies, and families losing everything. A young Warren Buffett watched people gamble their savings on stocks they didn't understand, companies they'd never heard of, products they'd never used. And one by one, those families fell apart financially. But Buffett noticed something. The losers chased excitement, hype, and rumors. The winners always knew exactly what they were buying and why. Decades later, when Buffett became one of the richest people on earth, surrounded by Wall Street analysts, he still refused to invest in any business he didn't personally understand. While everyone ran toward the next big thing, Buffett quietly ran the other way. One day, the world discovered he had been right. But why would the greatest investor refuse entire industries for decades? Why did he avoid tech during the dot-com boom? The answer lies in the chronological story of how this rule shaped every stage of his life. The rule began in 1951. Buffett was a 20-year-old student under Benjamin Graham, father of value investing. Graham taught him something that changed everything. Investment is most intelligent when it is most businesslike. You're not buying a stock. You're buying a business. And if you don't understand the business, you can't judge its risks, you can't judge its future, and you definitely can't judge its price. Buffett tested the rule with small companies he could fully understand. Newspapers, insurance, retail. He studied them deeply. And slowly the rule worked. His small investments turned into life-changing returns. By the 1960s, Buffett was managing partnerships with unbelievable performance. But everything changed with one decision. He bought a failing textile company called Berkshire Hathaway. He understood it enough, but not deeply, and it failed. The textile business drained cash for years. Buffett learned the toughest lesson of his career. Understanding just enough is not the same as truly understanding. So he doubled down on the rule. He bought simple companies with simple business models. Coca-Cola, Geico, American Express, businesses anyone could explain in one sentence. These companies became the pillars of the Berkshire Empire. Then came the breaking point, the 1990s tech boom. Dot-com stocks exploded. Wall Street mocked Buffett. They said he was outdated, slow, and missing the future. Magazines asked, has Warren Buffett lost his touch? Meanwhile, millions of people invested in tech companies they didn't understand at all. Buffett refused to join the hype. And when the bubble burst, losing $5 trillion, most people were wiped out. Buffett lost nothing because he never invested in something he didn't understand. The rule saved him again in 2008. Banks collapsed. Companies died. Markets fell apart. But Buffett survived and even invested aggressively in the companies he knew best. Later, after years of studying technology, he finally invested in Apple not because it was trendy, but because he truly understood its business model. That investment became one of the greatest in Berkshire history. The rule did not change. His understanding did. You would think that after so many crashes, people would learn. But they don't. Every decade, investors repeat the same mistake. Buying things they do not understand. Meme stocks, hype coins, influencer tokens, AI projections, pump and dumps, and startups with no revenue. The patterns repeat because humans prefer excitement over understanding. But the data is even more shocking. Studies show that 80% of retail investors buy stocks or crypto assets without reading a single financial document. During the last crypto bull run, over 60% of investors couldn't explain the technology behind the tokens they purchased. Buffett's rule isn't old. It's not boring. It's not old-fashioned. It is timeless, because as long as people crave shortcuts, the market will punish them. So here are your 3 takeaways. Number 1, simplicity beats complexity. If you can't explain how a business makes money in one sentence, you don't understand it. Number 2, boring usually wins. Buffett became a billionaire by buying companies like insurance firms and soda brands, not viral trends. Number 3, understanding is your armor. Crashes don't destroy people who know what they own. They destroy people who follow hype. And here is your final warning. You are living in the most confusing financial era in history. Viral stocks, AI tokens, secret algorithms. Everybody wants you to buy something, but the danger isn't the market. The danger is not knowing what you're buying. So the real question is this: in the next crash, and there will always be a next crash, will you panic because you never understood your investments? Or will you stand firm because you knew exactly what you owned? Or if you want more no-nonsense financial breakdowns like this, hit like, subscribe, and stay connected. Because in the world of money, understanding is how you win.